So the authors are looking at the Portuguese stock market from 1988 to 2015, and they're wanting to see how well portfolios perform if they contain both characteristics of value and momentum. So for their first test, they form portfolios into thirds by ranking according to their value and momentum characteristics. And so for value, they're ranking on the price to book ratio. And for momentum, they're ranking on the past returns. And so, for example, ranking them into thirds, they would put the stocks with the lowest price to book into the highest ranking portfolio because it's more value related companies. And then the growth companies would be in the bottom ranked. So they would rank these into three different categories, and the more value related companies would be in what they call P3, and the growth companies would be in what they call P1. And so they do the same thing with momentum, where the stocks with the highest past returns are put into the P3 group, and then the stocks with the lowest past returns are put into the P1 group. And so now that they've got those portfolios formed for the value and momentum, they create a zero cost portfolio, and that means they would go long the P3 portfolio and short the P1 portfolio for each of these categories. And that should give you the amount of return that the more value related companies outperform the growth related companies. And the ones with positive momentum outperform the ones with negative momentum. And so finally, they've taken both of these zero cost portfolios and formed them into a single portfolio that is attributed 50% of the value zero cost portfolio and 50% of the return of the zero cost momentum portfolio to see, well, how would this combined portfolio perform based on having characteristics of both value and momentum. And they've presented their results in this table here. And we can see here's the observation periods, and these are the holding periods for purposes of the momentum. So for instance, the observation period would be the time period of the past returns. So 1 month, 3 month, 6 month. And then a holding period would be the number of months that you hold these securities. So 1 month, 3 months, 6 months, so on. So for example, this observation 3 would mean they looked back 3 months to get the return, and then they held, if we're using H3, then they held the portfolio for 3 months. So this is used to determine the ranking, whether P3, P2, or P1, and then this is used to calculate the return. Anyway, for all categories, the average monthly excess return, so these are zero cost portfolios, so this would be the P3 minus P1, so value minus growth, and positive momentum minus negative momentum. So we see that holding this value momentum portfolio outperforms the growth negative momentum portfolio by somewhere between zero point 0.4 and 0.6 percentage points a month, looking back at the past 1 month. And looking back at the past 3 months, we have a little bit better returns. 6 months, a little bit better. 9 months and 12 months, about the same. So we see in all cases the value momentum portfolio outperforms the growth negative momentum return portfolio. We also see in most cases we have T statistics that are statistically significant at the 1% level, I believe. Yep, 1% significance level. And this only really occurs at the holding periods of, it looks like, 3 to 9 months. Whenever we look at holding for 1 month or 12 month, we're not statistically significant. So it's hard to, well, not as significant as the 1%. So it's harder to hang on to the notion that these excess returns are different than zero. Although another interesting thing to note is that the holding for 1 month seems to outperform holding for longer periods of time in most all the cases. So we have a 0.75 and then it continues to decrease as we go on. However, what's also interesting to see is that as the holding period goes on, the standard deviation seems to decrease as well. So actually, if you're holding for longer time periods, you get a higher Sharpe ratio, which is basically just the excess return over the standard deviation. So from a risk-adjusted standpoint, you might say it's better to hold for longer periods of time if you're using the Sharpe ratio as your metric. We also see if you're using alpha as your determinant of a risk-adjusted return, it seems to be better to hold for longer periods of time as the alpha increases. I'm assuming they're using the CAPM for their alpha formula. But in most all cases, it doesn't really seem useful to hold for a full 12 months. Maybe the 9-month holding period is the sweet spot in most cases, it seems. So next, the authors broke down the returns into different sub periods. So we have here 94 to 98, 99, 2002, so on. And they've also broken it down into the combined portfolio. So that was the one that has both value and momentum, zero cost portfolios where they put half and half the return into each group. And then we also have the momentum alone and the value alone so that we can see which one contributes to the portfolio and its return. And we see in all subperiods that the average return of the combined portfolio is certainly positive, but there's periods that did better than other periods. And just from knowing the understanding of the past economic cycles of the stock market, it looks like late stage growth in stock prices seems to be the best time for this the combined portfolio. So going over here to look at the momentum and value portfolios separately, we see that momentum seems to do very well and absorb most of the return for the combined portfolio. And in fact, value had a pretty tough time in the 2008 to 2011 period, whereas momentum did really well. And so this falls in line with a lot of prior studies that show that momentum returns seem to be somewhat negatively correlated to value returns, and that's what gives the combined portfolio so much of its power, is because it creates a really good diversification. And we see that down here where they've calculated the correlation of value and momentum, and they found it to be a negative 0.22. Okay, so next the authors are looking at the different momentum and value zero cost portfolios. So that would be P3 minus P1 of each different type of portfolio. And they're looking at the average returns over the different holding periods from 1 month to 36 months. And what's interesting to see is for instance, the value portfolio. It looks like it continues to increase in excess returns until maybe about the second year where its returns somewhat level off. However, the momentum portfolio makes it to about 12 months, so 1 year, and then its returns start to decrease all the way to where you have no excess return at all. And this falls in line with prior studies that have found a delayed overreaction that makes the returns fall back in line. So next, the authors sort. We know we've discussed value and momentum stocks being sorted into three categories that they call P1, P2, and P3. And so here, instead of combining them in the way 50-50 that we discussed earlier, they've created 9 portfolios that show, for instance, momentum. P1, these are the past losers, and P2 in the middle, and P3 past winners. And then they've also got the value portfolios with the P1, which is the growth companies where they call expensive, P2 in the mid grade, and then P3, which are value companies. And then they created 9 portfolios based on each of these. And so for each of these 9 portfolios, we have the average return of holding that portfolio. For instance, if you held P1, so growth stocks and past losers. And then down here we have P3, which would be past winners and value stocks. And we have the different descriptive statistics that they use. For instance, here's the past returns. And we see that this past return increases as the P1, P2, and P3 increases. I mean the portfolio level is increasing as the past returns increase. And then from the value side, we see the price to book ratio goes down and down as the portfolio level increases. So that shows that we've got value companies here and growth companies here. Anyway, over here in the last column, we've got the P3 minus P1 statistic to show us the excess return of holding the either value or moment or past winner portfolio versus the growth or past loser portfolio. And we see in all cases that the excess returns are very high, and also the T statistic is significant in most cases. And these are for the value related, and then down here we have the momentum related, P3 minus P1, and you can see this where it's the 0.5% minus the negative 0.8%. And if you were to do it here, it's the 0.4% minus the negative 0.8%. Anyway, we see that by holding the P3 portfolio and shorting the P1 portfolio, we can get some excess returns there. And then next, the authors compare holding the combined value and momentum P3 portfolio. So that would be the one that has the highest value and momentum signals over a period of 5 years. And then they compare that to the returns of the P1, which would be the lowest momentum and value signals. So more of a growth and negative momentum portfolio. And I actually think they had this legend backwards. The this blue one, I believe, should be the P3, and this red orange one should be the P1. And that makes it in line with what we saw in the prior tables, where the return of holding the P3 far exceeds the return of holding the P1. But what's interesting to see is that over time, this difference between the two eventually narrows to be very, very close together. So holding the P3 portfolio for maybe less than 24 months or so gets you about the same excess return as holding for 1 month. But by holding it for more than 5 years, you get about the same return as holding the P1 portfolio.